this is one that's a little tricky because it starts off sounding inflationary and other things. So you got to be careful. Part of what she's doing is she's setting up what does the market think, and that's a big part of tactical, because if you think the market's going one direction, you think it's going to be the opposite. It gives you something to trade on. If you say, hey, the market thinks it's going to happen, we agree with them, there aren't that many tactical moves. You probably should just buy the market because everything's priced well. So inflation is high, but she's not saying she's expecting it to be high. She says it's temporary, so that's pretty important. So essentially, she's doing the Fed lag argument, which you'll hear this a lot. The Fed, when they do things, it takes 6, 9, 12 months before it actually feeds through. So they're addressing something she says is temporary, and it's going to abate, and then the Fed's, all their action's going to hit. So the Fed's going to be killing the economy after everything's already been fixed, and then they have to undo that, so they have to cut rates. So that's kind of the Fed's 9 to 12 months to get something to happen, kind of creates longer term negative impacts. And energy prices, we talk about core inflation. There's a couple reasons for core inflation. People always say we leave out energy and food because they're volatile, but they're also deflationary. When energy prices and food prices are high, people cut back on everything else, which becomes deflationary because you have to buy oil, you have to buy food. So not only are they more volatile, but they also tend to cause other prices to fall because of people change their behavior. So that's the argument we're making there. So as such, I see an outright recession, so that's pretty negative. The Federal Reserve will raise short rates, gotta be careful, but then aggressively cut. Inflation suddenly drops. Economic growth turns negative. Longer term rates will fall dramatically. Rates will become much more volatile. Everything you need is really in that one paragraph. Corporate earnings will fall well below expectations, but we essentially already said that because that's what's going to happen. Core bond spreads will gap out, so that's kind of obvious. Europe might be the one positive spot. The euros will rally, so I'll keep those two the same. Emerging markets have an intense sell-off. Commodity prices will reverse course. Marginal tax rate 30%. Did I miss anything? It has all the pieces, so you can see where the economy is going. So fairly negative, right, throughout this entire thing. So underweight stocks due to worsening conditions. Okay. Overweight bonds due to the following: inflation and worsening economic conditions. Lengthened durations. So all right, so on the exam, it'll be one person. That makes it a lot easier for me to grade when a team writes the paper. And y'all know an exam, it's not a team exercise, right? On the exam, everybody's doing their own thing. I've had stupid students walk in thinking it was, so I don't know how to do that part. So, all right, overweight bonds due to falling inflation and worsened economic conditions. I'll give you 0.5 because you got to let me know you're talking about long-term treasuries here. I assume that's where you mean here. Lengthened duration, tips, underweight tips, falling inflation. Okay. Municipal bonds, what was the tax exempt yield? I remember. Wasn't it 351? 351 versus what, 0.0246 divided by 1 minus 0.3 equals 0.0351. So much higher. Duration, we believe, since that short duration first, since increasing rates, and then move the long duration. All right, so be careful on the exam that you tell me whether you're overweighting or underweighting. So what kind of municipal bonds are these? They're long term, all right? So they were trying to hedge the bet here. Rates going to rise and then they're going to fall. So they're essentially saying they like the long term, we're gonna go into them slowly. It's just gotta be real clear on the exam, all right? So make it really clear. It's probably clear on the exam when you're not doing it as a team exercise, but I'll give you 0.5 on that. Quality believe they're it's high quality, so I'll kind of give you that. Taxes, 351 is greater than 250, so prefer corporates and prefer high municipals. High yield, we want to underweight, expect weaker economy. We already got stocks overall, right? Okay, large cap defensive stocks because rates are rising. We should move over to defensive stocks. All right, so why are you moving to defensive? Because rates are rising. Oh, it's because of the economy, right? So you gotta be careful on that one. Because of the recession, first off, we should, within stocks, allocate more to large cap. There's one. This one, I don't think I can give you anything there because you said it's because rates were rising and then falling. So did y'all say it? I'll just not say it. So mid cap underweight due to recession, or I'll give you that. Underweight due to yeah. So all right. So here's a good example where we got two things here, right? Underweight what? Underweight mid cap or underweight value. So they'll get 1 point and they'll lose a point because it wasn't clear. I didn't say anything about stocks and interest rates with the one exception of growth versus value. Do large cap prefer rates rising or falling? I have no idea. It depends entirely on why they're rising. Rates rose in the 70s and large cap did horribly. Rates rose here recently and they did great. And it just depends on why they're rising. If they're rising because of inflation, they tend not to do very well. So, right, so I can't give you that one. All right, so this team, for some reason, y'all making an argument. So you can do that on exam, but you better have a lot of data to support it. All right, so you better have charts to prove that mid cap do better and rates do something. I don't think that's the case, but you're probably not going to have time on the exam to do that research. Plus, you don't have access to the internet, so you probably can't do that. Interest rates are falling, and we expect high levels of volatility. We want to buy convexity. Okay. Vol interest rate, you want to buy convexity. Since we expect a recession, we want the length and duration and capture the wider credit spread. That I don't understand. So you want to explain that one? A recession, you do want to lengthen duration. What do you mean by capture the wider spread? So how does that work? So spreads are narrow, they're going to widen. So we expect a recession. Maybe you're saying we get a recession, spreads widen, then we're going to move into higher spread. But you got to be real clear, all right? So I can't give a point there. Developed markets overweight Europe due to positive crisis outlook. Overweight has a weak dollar, all right? Underweight emergings due to consumer cutbacks. I mean, you kind of, yeah, okay. Neutral on gold due to inflation being low. So there, you could have mentioned the US dollar, right? Inflation is not an issue, but the dollar is going to be weak. You could make an argument for gold. So all right, so I'll give you one there. Real estate, good time to buy. Distressed properties. I don't think she gave you enough to do that. So I'm not going to, you can't put words into her mouth, okay? She forgot to mention about the real estate being really strong. You know, you're not going to get points for that. So underweight energy commodity. Okay. So, all right, let's see if we can do this. 3.5, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. I think it's out of 18. Let's see. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. So 15 out of 18. That's pretty good. Yeah, give them a hand. Yeah. So yeah, 15 out of 18. All right, don't know what's going on here. Sorry, good old Zoom. So 83%, that's not bad. So it's probably worse doing it as a team because it's it's hard to coordinate your answer that way. I don't get feedback on the team just because it's just from a time standpoint. I've got what your scores are, but I don't. Yeah. I mean, if you want feedback, you'd have to come catch me sometime and tell me to keep your paper because I'll throw them away as soon as I grade them just because of time. Adrian? She didn't really give me much to talk about there. There's not much on venture capital. Venture capital is essentially small cap without the volatility, but that's all fake. So if she says she wants more diversification, some people believe venture capital provides diversification because it's this fake low volatility. Most people don't really believe that's true, that they're doing just as badly as everything else. It's just we don't know. Other than that, it's hard to really say venture capital is anything. It's just small cap, but not traded in a public market. So it's tough. But the only way you get venture capital is a diversification argument. That's a pretty weak argument to begin with. Yeah, you could certainly, for real assets, talk about the protection of inflation and our diversification. Yeah. Yeah, research is small cap. Yeah, I mean, that's what the math shows. They're just small cap. Other questions on the practical? I forget when the exam is, so it's coming up here. I can't remember. I can't keep classes organized. It might be, yeah. So yeah, some students complain because I don't have, I don't have much up front in the class, but just do well and you have to worry about it. All right, so I did get a one paper just to look through it real quickly. Oh, sorry. Okay. There it goes. All right, so this was by some last name. Start off with an abstract. So in their abstract, they didn't say what the report said. They just said what they're doing in the paper. You could say really strong report or whatever. When I think about this, I'm an outline person. I always think before I even start writing, I want to know what I'm going to say. You might not be that kind of person, but what I am going to do intro. So she did that. Then you have the jobs and inflation and work hours. Then you have the unemployment, participation, labor participation. I put those together. Labor participation goes with the jobs with the unemployment rate. All right, I've seen some students talk jobs report, labor participation, and the unemployment. It just seems strange to me because the participation should be with the unemployment rate. Now, several students use one of the student examples, and so I've seen this where they talk to jobs report, then they jump into the stock market, then they jump back into the PML, to the ISM, and then they jump back to the bond market. And that's because that's what that student example does. It doesn't make any sense to me that we suddenly start talking about the stock market and then go back to talking about the economy. So here you might say other economic indicators. What could that be? Well, it could be ISM, could be jobless claims, could be CPI, could be, oh man, there's so many other ones, etc. JOLTS. And here you want to say to add some more context. So you want to set that up because your boss asks you to talk about those things. So you have to say, but I would put it in this section. So I would transition from the labor participation into, hey, just give you greater context. Boy, the ISM sure has been weak lately. So we've got this contradiction going on here, which makes it a little confusing for markets. The jobs market is extremely strong, and yet ISM is already showing quite a bit of weakness. The jobs report is a coincident indicator, whereas ISM is leading. So that may have some, but give it some context. Why did you put that in there when she didn't ask you for that? And then you have an intro to the markets or a summary of the eco. So, it's a good transition. So you just say, hey, wow, it's a really strong report. Generally, that would be great for stocks and bad for bonds. However, in the current environment, people are worried about inflation, worried about the Fed. This jobs report might actually be interpreted negatively by both the stock and bond market, and that in fact is the case. Then you jump into the stock market. So you have a transition. You can, that makes a lot of sense. So you would think this would be good for stocks, bad for bonds, but in this environment, those are good phrases. In this environment, blah, blah, blah. Then you talk about the stock market. And if you're going to talk about multiple stock markets, I would put them all there. So if you can do, you have to do S&P, but you might do small cap and whatever other growth versus value or individual stocks. And then you do the bond market or markets. Other markets. That's where you might do gold, you might do oil, or whatever else you might do. And then some summary. One example paper I saw, the summary was almost as long as the original discussions. So that's going to be much. If the summary shouldn't be 7, 8, 9 paragraphs, 1 or 2 paragraphs. What does it all mean? Some final argument. It can be one final summary or a forecast. What this all means going forward. That kind of thing, a section. What does this all mean going forward? That to me is a logical. So make sure your paper, you've already written it, so you might step back and write your outline now and see if your outline makes sense. So the one student that had put ISM here, I said, yeah, if I were you, I would move that back up in the economic discussion. And so they did that. That just made more sense to me. So don't jump back and forth. Have an economic section and a market reaction section, and have them logically organized around each other. If you're going to talk about other bond markets like corporate bonds, then put that under the bond market discussion. So your goal is to communicate. Your boss said, hey, I want to know about the jobs report. And you just know, okay, that means the jobs report and how the markets reacted. That's pretty obvious. But other things came out this week, or obviously this jobs report's, the focus is on CPI. Maybe maybe she hasn't seen the CPI numbers in a while. Maybe I'll throw a chart in on that, even though it's old data, whatever you want to put the context in there, you can throw those other things in. You don't do it. Unlike your college professors, your boss is probably not going to grade you how many papers, how many pages long it is. They're probably going to grade you on how well you communicate. So always like, does that really add anything to it? Is that useful information? If it's not, don't put it in there. I don't know what the JOLTS report last said, but if it's not telling you anything interesting or new, then don't put it in there. All right. So don't put stuff in just because the example paper from last semester did it. It may not be important this time. And that's what you have to do in your first job, is you got to start deciding what's really meaningful here. What makes sense to tell someone. All right. So with that in mind, the jobs report is one. So yeah, this kind of stuff is fine. I wouldn't do it in real life, but it's fine. Your boss has asked you to do this. You're going to go, oh, by the way, boss, what you asked me to do, I want to let you know it's actually really important. She might take that well. She might find that insulting. I don't know. What do you think she would think?
You said like not to like explain to your boss or other people like what this is, right? Cut that out.
Well, that's my point here. She's the one that asked you to write this, so I would think she knows what this is already. So, hey, boss, I didn't realize, you may not know this, but this is actually, I discovered the job report is actually really important. I thought you might give me something unimportant to do, but I discovered. Now, for this purpose, it's fine for this paper because you're documenting, you're kind of teaching yourself, which is fine. You should do that, so you learn that, and then, but in reality, see, I don't count off for that. In reality, it's fine leaving it in there because you want to kind of document for yourself.
Because I took a few hours like writing what it was, and I'm thinking you guys should probably know what it is anything. But
Well, you should know what it is, so writing that is not a problem. It's like my secure analysis class. They write this 70, 80 page paper and they finish with an exec summary, which is all anybody's going to read anyway. You think, my word, I just wrote 70 pages so people can read two. But could you have written those 2 pages if you hadn't written the other 68? You needed the other 68 to write the 2. So you need that. Sometimes you're going to do a lot of extra work, but it's not going to go on the paper, but you're going to be better off because you learned it. So it's fine. I don't count off for that. It's fine. You can put it in there, but don't do it in real life. Okay. Don't educate your boss. Your boss probably won't like that. According to economy, the number of years. Okay. When you're reporting highly recognized headline economic data, you don't have to source it. All right. It's not required to source it. I don't count out for that either, but you don't have to say according to. Like, according to Yahoo Finance, the S&P 500 closed at 4,100. You don't have to do that. If it's well-recognized numbers that are everywhere, come from the Department of Labor, just say the numbers, okay? Right, so now, here's the numbers. So they gave the numbers, so that I'm looking for that number. She gave the expected, and she gave the range. Here's one time I might give the range. When will you get the range? Well, when it's way outside the range, that might be a time, because not only did it beat, but it was outside the upper range. So here's one time where the range would actually be pretty useful. So that's good. She gave the January job number. So, you know, be selective with your words. Did she need those extra words, which was later revised and changed? So remember, when you're revising, you've heard that old saying, I would have written a shorter paper, but I ran out of time. Heard that before. Each edit probably is going to get shorter and shorter and shorter, so you want to tighten it up. Now, if I were she, I probably would have put this first and then that. I think you could probably get all of that into one sentence. The jobs reported for January is 517,000, much higher than the 185,000 expected, and even above the upper end of the range of 260,000 jobs, and much higher than the previous month's number of 260 revised up 27,000. You know, I could probably get it in one sentence. So, you know, work on keeping it. I mean, what does your boss want to read? 20 lines or 3 lines. If you can get it to 3 lines and say the same thing, that's what you want. Now, she didn't use 20 lines, but she probably, I think she probably could have gotten this. Some of this is she's adding the extra data, which is fine. Jobs apart, but again, your boss probably doesn't need that. So it's kind of additional information that probably is not helpful to the boss, but I don't count off for that kind of thing. Job growth was widespread in January, led by gains in leisure. Professional employment also increased in government, partially reflecting return of university workers from a strike. So that's good. It's good to say where it's coming from. Now, I've seen a few of y'all have used the table. I like the table that shows where the jobs came from. Last week or no, a couple weeks ago, our chief economist at Investment Society actually showed a really, really good chart on where those jobs coming from. So that was there is a chart. Some of y'all found it, haven't you? that shows that. The strange thing with the chart I'm seeing is it shows the ranges. I'm not used to seeing the ranges at this industry level, but that's fine if you have it. All right, the unemployment rate was reported at 3.5 last month. I would, if I were you, I would start with this month's actual. What do you think is your boss, the most important number to your boss? This month's actual, what do you think? So the unemployment report came in at 3.4%. Meeting expectations, and 0.1% or 10 basis points lower than the prior months. You can get that all in one sentence, but she does have it. There's last month's. Nice thing about the unemployment number is it's not revised, so there's no revision numbers to talk about there. And she's got the expectations. So she got the three things there. Be careful though, when you're talking about a change in percent, it's better to say 10 basis points than to say 0.1%, because it's hard to know if it, I'm sorry, spam risk. So it's hard to know what you mean by 0.1%. That can mean a couple of things. So down 10 basis points, there's no question. It's down from 3.5 to 3.4. The lowest level since May 1969. That's a great little ad to put in there. That's powerful. If you can give historical context, that's always really important. Long-term graphs are great to do as well. That helps put some context into it. According to this polling, clearly not as close to recessions as we suspected. So put some quotes in there. That's good. She didn't separate it out and italicize it because there's only just a few words. If it goes on more than one line and you want to separate it and make it kind of stand out a little more. Private payrolls. Now, to me, private payrolls go with the jobs report. However, this is an approach that works as well. You do the 512 and the 3.4%, then you go into the details. That's a perfectly good approach as well. All right. What is strange to me is if you do the 517, then the participation rate, and then the unemployment rate. That seems strange to me because, you know, but if you want to hit the 517 and the 3.4 first, and then start doing the details, that would be perfectly fine. So that's the way she's doing it. Private payrolls. So I'm a little confused on this one, why it was later revised. Because we're talking about January, right? The predicting consensus was 170. So on private payrolls, the actual reported numbers. So this is a little confusing. This is December, isn't it? I can't remember. I don't have it in front of us. So January is the number you're doing, isn't it? So there's no way January was revised. So there might be she probably meant December here. Right. Again, I would lead with the current month and then bring the others. And again, I try to get all in one paragraph. Private, you know, the consensus could be important. The previous month can be important, but the main thing is, you know, make sure you talk about private. Participation report was slight increase. Here she got it all one place. Was a slight increase. I don't know what this means of an actual. So, I mean, this is still a draft, so she's probably going to be editing it still. So I'm not criticizing her writing skills. Just, you know, as you edit it, find those typos. Was a slight increase to. These measures have shown little change since early. Okay. Make sure you close your quotes. I don't know exactly where it closes. In addition, over the past 12 months. Now here, well, that's probably okay for a quote. If the quote's just telling you what the numbers did, just stating facts, that's probably not a quote that you need to do. You know, according to Tom Jones at Barclays, the S&P, you know, was up 50 points. It was up 50 points. quoting that person is not adding any. It's like, wow, that's really no. So make sure, so read this and say, is this quote telling me something that's really insightful to the numbers, or just telling me something about the numbers I can just state? So that's helpful. And over the last 12 months, average hourly earnings. So yeah, these kind of things you can certainly talk about, the work week, those kind of things. That's fine. So the way she did it is she put all the other stuff all together. That's perfectly fine way to do it. Kind of just rocket fire, put everything in there. All right, so here, just set this up a little more, furthermore on the first day of each month. So maybe you define ISM. I would just make it clear. I think it is helpful to provide some context to this jobs report by bringing in other economic indicators, something like that. For example, the ISM came out 2 days earlier. It's a good, whatever. What I think is important about the ISM is the big contradiction in the numbers. So, or you could set up the ISM and say, hey, while this jobs report looked extremely strong, not all economic numbers have been strong recently. For example, on Wednesday, the ISM came in, then you have the context. You're saying, hey, not everything's positive. So is that good news or bad news? It's kind of, the Fed obviously is aware of the ISM. It's a better predictor of the economy than the jobs report, because the jobs report pretty much tells you where you are now, not where you're going to be. And remember, the Fed's actions are 6-9 months out anyway, and the ISM's telling you, and that was the negative one. So I would probably have set it up with this contradiction. So where are the contradictions? Retail sales, what is it that maybe wasn't so strong that might have contradicted this there's no question that it was a very, very strong employment report. You can't explain it any other way than very, very strong. I get confused between the ISM and PMI. So if you want to put them both in there, that's fine. But yeah, definitely. But give it some context again. Don't just talk about it completely divorced from the unemployment, because you're talking about the unemployment. All right. So find some way to connect them together. Someone sent me an email or text. I can remember who sent them, but I can't remember what they said. But about the tech companies layoffs. You could certainly talk about that and have those quotes, but it's definitely not enough 500,000 yet. All right, so if you're going to say that, that might be one of those things. Say another thing I'm seeing here that seems to contradict this report is the headline we've been seeing about tech companies, and you can have some quotes there. But again, you set it up as a contradiction to what you just said. The worst thing you can do is talk about the jobs report and then talk about the weak ISM and never reconcile that contradiction. So we got a really great jobs report and a really horrible ISM. Any other questions? Well, wait a minute. That doesn't make sense to me. Okay, market ramifications.
So everybody said other economic indicators. I put in, that's all the example, I just had to put it in GDP. Can you see that out, or is that?
Well, GDP, the problem with it is it's really old information, and it's really slow, and it's only quarterly. So it depends on when the last GDP number came out. I mean, it could fit somehow if you just want to get, say, are we in a recession or whatever? I can't even remember what the last GDP number is. GDP rarely moves markets. First of all, the first GDP number is always so wrong anyway. Plus, everything in that report we already know anyway. We got it with other reports, so it tends not to be a big one. But it wouldn't be wrong if you have it in the right context.
Right. Thank
you. So the report, she established the report came out on February 3rd, because that's the market she's going to talk about. Let me draw a line under today's charts. So this is a good way to get into the market, is to have some good quotes, kind of talk about it. You want to somewhat transition, whereas is this good news or bad news for markets? So we're kind of in a good news is bad news kind of environment right now anyway, because of the inflation and the Fed. So with an increase in average earnings, the markets reacted positively. Is that initially? So markets reacted positively. Exactly where is that? I'm not seeing that. So I'm kind of questioning what they're saying there. Now, if there was an initial positive, just have the word initial in there, the market initially reacted positively, but sold off the rest of the day, whatever. So just make it really, really clear. So if you're going to talk intraday, that's fine. Just make it really clear. You don't have to provide too many numbers. You can say the low and the high for the day. I tend to prefer those as percents rather than numbers, because then I have to do the numbers on my mind. So the S&P closed down 43 points, or 1.04%, off of its low for the day of minus 1.3%, but much lower than its high for the day, which was open. Whatever. Give some context. I get lost with a lot of 4,000s in here, so so kind of think about that. What your boss really needs there. And she talks about the NASDAQ. She has charts, so you definitely want to have charts. Make sure they're easy to read. So she's talking about inflation, but she's talking about bond market interest rates, so it kind of makes sense inflation would be there. Rising bond yields are negative for bondholders because inverse relationship. When yields rise, prices. Yeah. That may be a little bit much for your boss, because they probably already know that, but the 10-year Treasury note price dropped significantly with an increase of 13.6 basis points in the closing yield. So she's got the three pieces in there, so that's good. She didn't say how much the price dropped, and don't say the 10-year Treasury dropped 3%. That doesn't make any sense in a paper like this, because there's multiple 10-year Treasuries out there dropping at all different prices depending on their yield and their coupons. So don't say that. Just say what they did. Make sure you have 13.6 basis points, not 1.36 or 0.136. All right. Then she talked about commodities, had some graphs. And she had a conclusion, came in very strong, even though the unemployment rate has fallen. The economy spending figures dropped. Usually when rates are low, consumers put money into the economy. Unfortunately, consumers have stopped spending money. So she's adding quite a bit of new stuff here. So just be careful of that. So if you're going to say stuff like that, put it in the front part of the paper. The end of the paper should not say anything new. Your final conclusion, you want to just say what I think is most critical here in 4 bullets that say what you've already said, but in 1/10 of words. Just say what I think is most critical in the report is here, or however you want to say it, or what this means going forward. So it's a little long for a conclusion. I would keep it pretty short. All right, so it's a good paper, but there's a lot of things. I mean, could this paper be improved? Could all of y'all's papers be improved? All of our papers can be improved. We can get better at communicating. So your goal is to get it as crisp as you can, because we can put this on LinkedIn. That's the kind of thing they're looking for. Do you get to the point? Is it clear? It's obvious why you're switching from one part to the next. So strong paper, but definitely could be tightened up quite a bit. I might grade 1 or 2 others on Wednesday. We'll see. They may change their mind after me doing this. Let's see. Questions on all that? Let's see where we're going. So this is what you got to be able to do. Now, does this change post ChatGPT? It's interesting. We'll see. Would your boss ask you to do this, or your boss ask ChatGPT to do this, and then you edit ChatGPT? Which do you think you're going to be doing in 5 years? Probably the latter, right? Essentially have ChatGPT do all the research, and then you just edit it and make it better. So why is your boss paying you then? What is your boss paying you for? Yeah. You got to be smarter than ChatGPT. Are you smarter than ChatGPT? So what is your boss going to pay you for? It's kind of scary, isn't it? What skills do you have? That's not. I have an engineering friend, and they use ChatGPT all the time. And it's for them, it's fast research. They just plug it in there, and they will sometimes publish that as their report with very little editing. It's kind of, the world is changing dramatically. So I don't know. I don't know the answer to that. No other questions on that? I think I said it's due on Thursday, but Friday night at midnight is fine with me because I have another class with an exam that I got to get graded by Friday. My challenge is I think midterms are due on Monday. I'm not sure. If I don't get everything graded, then all this can get B's on midterm. All right, because I haven't found a student yet that cares about midterm numbers. I know you care about your grades, but you don't care what's actually in midterms. But hopefully I'll get them all graded by Sunday night, and we'll have it in there. So, all right, no other questions or comment? Why is my screen sharing paused? That's not good. Right, I didn't intend that to happen. Boy, all right. My Zoom lawsuit's going to be an interesting one. About 5 years. Could they improve Zoom? Or you can improve your paper. I wish I could have an interview with Zoom because we could do this a whole lot better. Okay. So I guess that whole discussion about the paper won't be out there, so hopefully you're taking good notes. All right, so maybe I will do another one Wednesday and try to get it on the Zoom. So, all right. So we're talking about asset strategy execution and the different type of orders, trades you can do. We talked about these last time. So you have a broker today. Your broker is just going to be a computer to do trades for you. I don't know if there's really full service brokers anymore or what they might actually do for you. How do you know you're doing a good job or your broker's doing a good job? It all comes down to benchmarks. Are you beating the market? If you're not beating the market, just give your money to Vanguard, pay 1 basis point and get the market and save yourself a whole lot of time. But you need to have a benchmark. The challenge for most Americans is they don't know what the return of their portfolio is. Brokers do provide that number. We're going to talk about that number because it's not the easiest number to calculate, and they don't provide you the number that's actually the number you want. Most of them give you a time-weighted return, and you want a dollar-weighted return. So most Americans don't even know what their returns are. So it's kind of hard to say you're doing a good job investing if you don't know what your return is. So it's a pretty good challenge. We'll talk about some of these indices here. All right, so if you hire a firm, let's say, okay, I'm not going to try to beat the market. I'm going to hire the firm. This is when the SEC Act of 1940 comes in, managing investment firms. So mutual funds, it's not as popular as they used to be because exchange traded funds have really taken over the world, but mutual funds are still out there and there's thousands of them. So in fact, the last time I checked, there was more mutual funds in the United States than there are stocks. So there's a lot of them out there, a lot of mutual funds. These are investment companies. They create trusts that have commingled assets. So BlackRock, Vanguard, Fidelity, they may be managing $9 trillion in assets, but that's not on their balance sheet anywhere. They're not their balance sheet. So if you looked at BlackRock's balance sheet, it doesn't look all that impressive. I don't even know what's in there, but it doesn't look that impressive. Doesn't look like all that big of a company. It's only $100 billion market cap. and their total assets are only 152 billion. How can a firm that's managing $9 trillion in assets only have 152 billion dollars in assets? Because it's not their assets. Why do we call it AUM? You know what AUM is? Assets under management, which just means they're assets they manage, but they don't own them. They're not on their balance sheet. So BlackRock, Vanguard, the two biggest. State Street's probably the third biggest. I don't know where they go after that. Fidelity, I don't know where Fidelity is these days. T. Rowe Price. These are kind of the household names we have. They manage other people's assets. It can get a little tricky. A firm like MetLife. MetLife has assets that don't belong to them that are on their balance sheet, and they have assets that don't belong to them that aren't on their balance sheet. So it's really tricky. MetLife, it's just a different type of accounting. So it depends on the firm and the type of asset, the kind of the legal structure that they have. When you have a mutual fund, they trade at an NAV. So the NAV is not a negotiated price between buyer and seller. It's simply the market value of the assets minus the market values of the liabilities of that fund. So it's not the value of the mutual fund, it's the value of the assets and liabilities that they hold that the market reprices. You get the NAV. If you buy it at the NAV. If you sell at the NAV. There's no spread, so you're getting exactly the NAV, but you can only do it once a day at the close. So that is the price that you will get. And what is the NAV? It's a number the accountants come up with. I did this for, I guess, 3 months because the lady who did this at UTSA went on maternity leave. And I was a newbie, and I volunteered in a second, right? You always volunteer. Oh yes, sure, I'll do that for you. So I did the NAVs. I'd get the value of all the assets, the value of the liabilities, and I had to get the NAV so that when you multiply that by the number of shares, it came out exactly to that value, which means I went out 9, 10, 11 decimal places if I needed to get it balanced exactly. And I did that every day. I had to do it right. You can't do it before 3 o'clock because the markets have to be closed. I have to have the values. I would do that, report it, goes into the newspaper. So I did that for a few months. It was pretty cool, kind of fun to do, to see that side of the business. The problem with this, if someone makes a mistake, you've got a nightmare on your hand because the next day, all this money flows out to these people that redeem shares, and you gave shares to people who bought. If there's an error, you just made a mistake that could have been with thousands of people. And how are you going to fix a mistake when you send someone cash? You're going to call them up in a few weeks, say, hey, we made a mistake. You really need to send us $500. That's not going to be a comfortable conversation. So you got to get these right. There was one night, I always monitor my mutual funds. And there was one night I was looking at my fund, and it was like, there's no way that NAV is correct. So just there's some mistake. So I called the accounting people. They all want to go home at 6 o'clock. Say, no, there's a mistake in there somewhere. And you would think they would cuss me out, right? But were they mad at me? They found a mistake. Were they mad at me? They were very happy. Because the mess that I caused that night for them would have been 10 times bigger if we discovered it the next day. So they were very happy we found it. They had to stay there a few more hours and fix it, but it was a good thing we found it and corrected it. Now, there was one day where somebody hit a key wrong on the S&P 500, not at USA, but someone out there accidentally typed the wrong just someone typed it and messed up NAVs all over the globe. It was a big mistake, right? You don't want your mistake to be that massive. But these are numbers people are calculating. They can't have math errors. They then type them. They can't have transportation. What is it? Can mix up the numbers. So they're not always 100% right because there's human error, and the human error can be disastrous, especially if it's material. But you can always sell at NAV in a day. That doesn't mean you get your cash tomorrow. So most mutual funds do have some wording that it can allow them to delay when they give you your cash. Because if everybody wants their cash out all at one time, the mutual fund may not be able to sell the assets fast enough. So you may have to wait. Some of them could be like 90 days before you get your cash. So depends, but you will get that closing NAV on that day. The advantage of a mutual fund is small investors can get really, really good diversification. And most of these funds might have a minimum of $1,000 or $3,000. And if you put it into an IRA, the minimum may only be $50 as long as you have a $50 a month kind of recurring. So they allow you to do some pretty small trades and get really good diversification. So allow small investors to hire well-trained managers. But today, what everybody is doing is exchange traded funds. So we'll talk through those. Commingled accounts, we'll start here on those. We'll finish up this. All right, I'm gonna go quickly through this. One more paper to look at. An introduction. This is a saying what you're going to do without any summary in there. Yeah, longer term charts are really good to do. We saw the PMI came out today. You can't use that in yours, but I do like looking at longer term. Oh man, our internet is just so slow right now. It's really frustrating. So yeah, give it some context. A lot of people like to go back to 2019 so they can show the COVID impact, but give it some go really, really far back because we're at the lowest level we've ever, we've been in 50 years. So you might do that. So there's certainly a lot that you can do. There's the 517. So since July, the Bureau has seen reported stagnant job that has ranged from 300 to 200,000. And be sure to spell it out. I'm not sure exactly what that means. That's kind of strange. I'm not sure what that means, but broke the streak with a reported 517,000, more than twice the consensus. And so she got it in 2 sentences. That's pretty good. She put the entire report in there. You can do that. It's not bad for this particular one. Sometimes it's a little overkill. She talked about where they came from, and then she had a chart from where they came from. That's pretty good. Participation. It's strange to me to do the labor participation before you do the unemployment report, but you can do that, but it's just strange to me to do that. Still well below pandemic levels. So she's got the participation rate in there. I prefer saying 10 basis points than saying 0.1%, but hourly earnings, I think, is important because everybody's talking about inflation. It's not always important. A lot of times it's completely ignored. Hours is very frequently ignored. I'm not sure that's the same hours they use for the productivity report. It probably is, but I don't know for sure. She at least says why it might be important, so that's good, rather than just giving the numbers. Say it might indicate this or that. That's a good thing to do. So she's got the actual, she's got the prior month, and she's got the expected. So she's got all those pieces. That's a big part of it. Unemployment report 3.5. So I don't see the expected. So make sure, because these are like the easiest points you can lose, is don't give the expected or the prior. That's like right there, you're losing like 2-3% on the paper for something really, really easy. So make sure you put that in there. Your boss, that's what they're thinking. Well, what was it last? Remember, your boss is pretty busy. And she's going to go meet the CEO. The last thing she wants the CEO to go is, well, what was it last month? Yeah, I don't know that. That's, that's pretty important. People want to know trends. Is it higher or lower? What was expectations? So have that in there. So that's important. Then she talks about the revisions. So it's again strange. She went jobs, participation rate, unemployment, and then, even between that. So it's essentially jobs, unemployment, jobs, unemployment, jobs. That's just strange to me. So you got the household survey, you have the jobs report. I like to keep them together, it just makes more sense to me. I'm not saying it's wrong to do it. but it's a little confusing to jump back and forth. So the household survey, that's the unemployment rate, the 3.4%. That's when they go out to households and ask them, hey, did you work last week? Versus the job report where they go out to corporations and ask them, what did you do? So I like to keep them together. So this is the actual jobs report, non-farm employment. Now, does she have the private? Yeah, she didn't give the private side, so you definitely want to show that number. What was the private payroll? She has some good discussion here, which is good. She has a jobless claims. You can certainly put that in for the week. That's one I usually on jobless claims, they usually do the 4-week average because it can be somewhat bouncy. And so we generally don't say the jobless claim rose or fell. We tend to say the 4-week average rose or fell because it's just a lot less noise. She put the jolts in there, which is fine. Jolts is kind of important right now. Then she went to ISM. So I would have added some words. I'd like to also show you the ISM to give a little more context to this report, especially given that the two are so different. Let's see if I can get this. Manufacturing. Here's new orders. That's a pretty important one. So you can, that's not the one we want. We want the actual percent. So anyway, to give it a little more context to it, one thing I thought was pretty interesting was the LEI. I like the LEI just because you got the best economists in the world saying these are the things that are most important for predicting the economy. Obviously, they know what they're doing. And you see that it's dropped, but look at previous recessions. So recession dropped down to 96, 2 recessions, 97, 97. I'm not sure that was a recession, but there's the Bush recession, 98. Obviously, when we had one here, 98, and then obviously 2008 dropped down to 95. COVID dropped down to ridiculous. So we're at 98 point something. So it's not that far off from a typical recession. What the LEI really looks at is the change in LEIs. So where was it and where did it go to? And so very good recovery, but that's a pretty scary number. So, those are kind of context things I like to see in something like this. A little more discussion on Powell, which I think is probably important to have something related to the Fed in there. You could have a whole section on that. Some good quotes. The one thing to be careful with hers is does it get a little too lengthy or too redundant? You just got to make sure it's not just the same stuff over and over again. So inflation is always obviously the thing. So yeah, she's got a lot on the economic side. Might be a little much, but I don't count off if it's too much unless it's just hard to follow. So if you're going to have that much economic stuff, you better have an overarching story you're trying to sell. Don't give your boss a bunch of data. This number's good. This number's bad. This number's good. This number's bad. Any questions? Like, yeah, what's the story here? Are the reports wrong? Are there errors in reports? Are some of them leading? Some of them coincident? Some of them lagging? So the employment is a coincident or even lagging. LEI obviously is leading. PMI is leading. Is that the problem? That the ones that are coincident, they still look great, but the ones that are leading, they look bad because the future, give it some context. And I would set that up right after I went out of the employment report. I would probably set up this whole section with all these discussions. While the employment report was very, very strong, we're getting some inconsistent reads on the economy. For example, the PMI is looking weak, the LEI is looking weak. So data related to jobs like the JOLTS, jobless claims are looking strong, but data related to whatever, give it some stories. And I'll give that story before you get into it. So your boss, it's tough when someone just throws a bunch of data at you without setting up what story they have in advance. So I would probably set that up. Conclusion on employment, although easing wage growth is encouraging, official government data releases we continue to point toward unbalanced and tight labor market. As stated, there could be a lagging effect of the tightening policy. So that's a pretty good summary. It's short enough. Market reaction, stock market gives what you should expect, which is not bad to do. Expect the stock market and especially tech stocks to dip considerably. As mentioned, the stock market saw a midweek rally. Yes, she talked about that. Make sure you have a chart on your stocks. You always want to give someone a picture of how it went throughout the day. Was it a rapid drop at the beginning? Was it a gradual drop over time? What exactly did you have? 43 points, that's good. Now, don't do this. Don't give me two sets of numbers. All right. That's really, now, what are these two sets of numbers? Drop 43 points as soon as the market opened. Yeah, I would probably just be careful, make it really, really clear. I tend to like percents more than points because I don't have to do the calculation. It's hard for me to know that 0.21. So it looks like it closed further down than it opened up, but how much more? It looks like the initial drop and the final close were pretty close to each other. So she talked about the week. You can certainly do that. A lot of you are using this chart. I kind of like that chart. She talks about the chart, so it's good if you get the chart in there. NASDAQ, she has the chart, talks about them, explains that it's tech stocks, small cap. Bond market, let's see if she get this right. Y'all can tell me. The 10-year treasury yield rose more than 13 basis points from its previous close at 350. Does that look good? What's the one things? There it is. So you need that. Bond prices fell, yields rose. I would give the exact amount, 13, I think it was 13.6, wasn't it? How many decimal places do you go? Yeah, I'd probably stop at 2, but it's not bad to go out there. So yeah, she's got the right pieces in there. Is that a big day? It's a pretty big day. So let's see. She somewhat implies by saying the highest one-day yield jump since October 2022. So she obviously had to do some work to go figure that out. I had to bring in some data. That's always a good context. Downward trend in markets, a little redundant. The market saw the downward trend in the market. So, always look at the wordsmithing, but she put the yield curve in there. That can be interesting as well. Did the yield curve flatten or steepen because of that report? That can be interesting. Currencies. You don't have to do this. This is what I expected. This is what happened. I can get a little bit, add a lot of length to the paper. I tend to be, one would expect from this report that stocks would do this. However, what we actually saw was I tend to do it pretty fast. Expectations in a few sentences, a few words, and then get right to the actuals. I don't think you want 2 or 3 paragraphs on expectations. You can, but it can get a little bit lengthy. Talked about several markets. Let's see on the conclusion. It's looking good because it's pretty short. Recent signs of unexpected growth in labor and lower productivity 11 points toward inflationary and possible recession conditions. The market react to the jobs report, seemingly higher inflation. Stock and bond market prices moved in the same downward direction, although stock market was relatively less reactive. FX. So I think you need to get off the stage sentence. It can either be a really, really great, your best quote of all quotes that you have. That can work really well. So Bob so-and-so at JP Morgan probably said it best. You have that quote and that gets you off the stage. Or it can be what this really, this boils down to this, or what bosses love to see is what I think is most important to watch from here is the upcoming whatever report, those kind of things. Get something, gets you off the stage, because here she's ending up with FX and gold. I think it needs one last little finalizing. No, I mean, y'all see that or not? The last thing you read, does it need to be kind of a powerful conclusion? I would say so. Something that gets it off. A quote can be a great way to do it. She has some pretty good quotes in here, especially on the economic side. So, maybe one of those would be better to push down to the very, very end. All right, it's a very strong paper. It's probably longer than what you'll do in practice. But that's okay for a college paper, because some of this is you're just experimenting with different data, sticking in, some of that is just, hey, I think I'll talk about jobless claims and just see what you get. All right. So they're due, I guess, tomorrow, but I won't start grading them any earlier than Saturday morning because I got to get my risk management paper exam graded. So if I get them by late Friday, I'll be fine. Won't be any. I don't know. I can't remember, how did I set it up in Blackboard? Did I say Thursday night? So yeah, if you turn it in by Friday midnight, you'll be fine. I doubt I'll even. It's probably going to take me 10, 15 hours to grade the risk management paper. Any final questions? To me, this is a fun paper to write. So if you're like, man, I hated writing this paper, then that may help you decide what part of finance you're going to be in. Because this is, not only is this what we do, but we love doing it. When we get together at parties, this is all we do is talk about this for 3 hours straight. And even then we're like, oh, I gotta go. We go out to our cars and we talk another 45 minutes at our cars. I mean, it's just what we live and breathe. So I mean, this is it. This is finance. Strong opinions, everybody's debating. I think it's pretty cool because there's so many angles you can take on this. All right. So let's finish up the execution here. So we last time talked about mutual funds. Mutual funds are somewhat falling out of favor. They're still decent investments. I hated mutual funds. That's one of the reasons I was retired. Oh, I hated mutual funds. What I hate about mutual funds is just so inflexible. Anything you want to do, you've got to get the entire mutual fund. All the shareholders have to vote. I remember once we found an error in one of our funds. I said, well, we got to fix that. We got to be able to do this. And they said, okay, that's fine. It's going to cost us $300,000 to get that changed done. It's like, what are you talking about? We have to do a vote. In fact, one I remember in particular, our high yield bond fund. He wanted to buy investment grade bonds because they had better yields and they were better bonds. So he's like, yeah, I can get a 15% bond that's really high quality instead of getting a 14% bond that's going to go insolvent. And the regulator said, well, you can do that, but only 5% of your portfolio because your portfolio is titled a high yield bond fund. So you have to be 90-something% high yield. So he said, well, I'll fix that and we'll just change the name to high income bond fund. Okay, well, that's several $100,000, 6 months. Yeah, you can do that. Does that sound fun? Something that's so obvious to do is going to add value to the portfolios, but because they used the word high yield in the title of the fund, they couldn't. It's just ridiculous. Commingled accounts are a little bit different because they're like mutual funds, but they're actual stocks. They trade like stocks. It's a lot more flexibility. UTSA, I think, or Victory Capital opened a few ETFs, some smart beta ETFs. So these have gotten a lot more popular. You can see charts out there that show mutual fund cash flows going down and ETFs going up. They become much more popular. The nice thing, one of the nicest things about them, you can trade intraday. Oh, I'm sorry, I skipped. I'm down here. I'll go back to commingled accounts. You can trade intraday. You can trade them just like stocks. Another nice thing about them is if they're trading for $70, you can buy 3 shares. Whereas mutual funds might have a $2,000, $3,000 minimum. So you can do smaller type of trades, you can do intraday trades. I used to question if the tax benefit was really there, but I saw an exercise where it really convinced me that they really are more tax efficient, but I can't remember exactly what I saw, so I can't tell you that piece. And they've gotten pretty ridiculous. I'll show you some pretty wild ones. So things like 2x funds, 3x funds, minus 2x funds. It's wild. So 2x fund, the S&P's up 10%, it'll be up 20%. The S&P's down 10%, it could be up 20%. It could be a minus 2x fund. It's just ridiculous. We have VIX funds, which is, I might show you some VIX funds next class. VIX funds, people get real excited. The VIX rises and hey, I've got this VIX fund. The VIX went from 30 to 80. Wow, that's great. I just made over 100%. And then you look at their fund and their fund's only up 30%. It's like, what happened? Because it's really hard to create a VIX fund. They do really well normal times, but when the VIX really jumps, they don't keep up and it's kind of irritating. But people are trying all kinds of really interesting things on ETFs. All right, commingled accounts. These are like mutual funds, but for really big investors. So most of the separate accounts we did, you're probably not going to go much smaller than $50 million. You're going to be a large investor. It can be the exact same thing the firm has on a mutual fund side. It's just they separate the assets and it's only your assets. They just put it all there just for you, or maybe there's only 2 or 3 investors. So it's a separate account. The first hedge fund I did was a separate account. We asked them, they had a 1-in-1 fund. So 1% expected return and 1% standard deviation. It was added on top of another fund. And I asked them, it'd be a lot easier if you make it a 20-20 fund. 20% expected return, 20% risk. Say, no problem, we can do that. So they created a fund just for me. Pretty cool. Wasn't difficult for them to do. It just made it much easier for me with the auditors to explain it as a 20-20 than a 1-1. Thinking, well, y'all did us a favor. And then they called me up a few months later. Someone else wants to be in your fund. And I said, yeah, I don't care. That's fine. So I guess someone else liked that same fund. So you have some flexibility here. They tend to be very similar to other things the firm has because they don't want to create a whole process just for one customer, but they can be pretty massive separate accounts. Especially on the bond side, fixed income tends to work a lot better as commingled in as a mutual fund. So, and then what most of y'all are going to do is your 401k plan. Essentially, these are commingled funds. They can be mutual funds that your employer gives you based on the tax law. Some of y'all may already have a 401k plan. Usually your employer will match up to a certain point. Who knows, I think USA was at 8% when I retired. It can be pretty significant. You want to get that match as much as you can because that's kind of free money that they're just giving to you. So take the match. And then what do you invest in? Well, what do they offer? So when I started at USA, we had 3 options: stocks, bonds, and essentially certificates of deposits. Those are the only 3 choices. And then I got my hands on it. We went from 3 to 13 pretty fast. And I don't know what they're doing now. I think they added 2 or 3 more after that. But yeah, we went from 3 to 13. What do you think I added? What? Not what do you think I added? Do you think I stayed with one stock fund? Any guesses what we added? No derivatives. I mean, what are we learning in this class? What stock funds could I have added? The only stock fund I had was a US stock fund. What could I have added? Could have added an international one. Emerging, we didn't do emerging, but we could have added emerging, but we did do an international. Small cap, yeah. What else? What other growth funds, value funds? Yeah, so it sounds like this class, doesn't it? We added all those things to it. On the fixed income side, we stayed with the bond fund, and we had the CD side. But yeah, we added 10 funds and they were all stock related funds, because that's where that's where most of that breakup is. So that's the 401k. So 13 options. There's some that do unbundling. I mean, they do bundling. So you get 500 options. Is that better? So I had this battle at USAA. You know, you fall on your sword occasionally, right? Every once in a while. This was the issue. I was going to fall on my sword. If you go to a firm that does bundling, I'm telling you, they're ripping you off. I think it's a horrible thing to do. So what does bundling mean? Now, one thing we talked about in our risk management class, if you manage one of these funds, who's your only customer? Is it the employer or is it the employee? What does federal regulations say? You can only make decisions in the best interest of the participants of the plan. You can't make decisions that help the employer. We talked about that with the pension plan, right? You can sole beneficiary. When firms do bundling, they're making decisions that benefit the corporation at the expense of the employee. So what is bundling? So this is how it worked with us. We talked to firms like Fidelity. So you go to Fidelity and say, hey, Fidelity, we got this 401k plan, and we're spending $500,000 a year on record keeping. Fidelity says, hey, you know what? Come to us. We'll give you record keeping for free. It's like, wow, that sounds great. How are you doing that? Well, don't ask. Just send us all that money. And what do? They intentionally overcharge the employees and they get much more than 500,000. That's what bundling. Does that sound like in the best interest of the employees? I remember seeing once where we looked at this twice. I battled it both times. There's once where we had an option which charged like 40 basis points, and they were going to give them the exact same option for like 60. And I go to human resources, hey, how is that in the best interest of the employees? And they said, well, we're giving them more choices. No, it's the same fund, it's just more expensive. How is that? But that was their argument. There's a really great, if you look at my book reading list, there's a really great frontline documentary on how evil this is. And there's one interview where they're interviewing this lady that you know for sure she knows she's ripping her customers off, but she plays like, oh, I didn't know that. I wasn't aware of that. It's like, and the next guy they interview said, oh, she knew that. She knows what's going on. I don't know why she did the filming, but she looked horrible in that particular one because it's pretty obvious they knew what they're doing. There are some employers that are so small, bundling is not their only choice. At USAA, there's no reason for us to do bundling. So we fought it both times. The second time is they hired some guy from a large corporation. He came in, he was just like tearing us to shreds. I can't believe you guys aren't bundling. Everybody does bundling. It's the smartest thing in the world. So I pointed out to him how bad of a deal was for the employees. I think he was a little shocked that he had so harmed his employees where he was from. If you have a 401k plan and you're not sure, come talk to me and I'll let you know, because it's pretty obvious to tell if it's bundled or unbundled. It needs to be unbundled because that means your employer is giving you the best possible deal with your money. At USAA, you got a $4 or $5 billion 401k plan. You should get really good pricing, really good funds for that. Your employees shouldn't be paying 60 basis points when they can pay 40. So I'm not saying don't take a job because of that, but after you've been in a job for about a year, you need to go complain to whoever's running the 401k plan. How many of y'all have 401k plans already? Do you know if it's bundled or not, Allison? Don't know. Yeah, it's hard to tell. Yeah, life cycles are fine. They can be. We had those. I'm glad you mentioned that. Was the other thing we added at USA were the life cycle ones. Those are ones that just say you pick the fund based on when you're going to retire. They can be bundled or unbundled, but yeah, you can use it if there's a lot of options. Is usually bundled. So if you have like 100 options or 200 options. And that's kind of how these firms, they say, yeah, it's a bad deal for employees, but the good thing is we're giving all these extra options. Think about the typical retail investor. Is it better to give them 200 options instead of 10? Does that help a retail investor? Hey, now you have 17 international funds you can choose from. That's just confusion. And on the second time, the first time I won because we went to the CEO and he says, that just makes no sense. We're not going to do that. The second meeting, he wasn't in the meeting. And that was the argument. Giving employees more options is just going to create confusion. And what do employees do? And we saw this over and over again. They get their statement every quarter. They look down the list, they find the highest returning option, and they move all of their money to that option. I used to call our managers and say, you're probably gonna get about 50 million bucks tomorrow because your fund had the highest return on the statements. They got their statements today. Sure enough, they get 50 million bucks. I'm just warning you, you're gonna be buying stocks tomorrow. And employees do that, giving them 300 options. It just takes them longer to go find the highest returning one to stick all their money in. It's not helping them at all. So our CEO, when we went from 3 to 13, he was actually complaining, why did they need 13? He was one of those, he did this a few times in my career. I don't know why you want to do that, but y'all want to do that, go ahead. He would wave his hand, that kind of thing, like a wave for me, you peon. But he's like, yeah, if y'all want to do that, y'all go do that. But I don't see why you want to do that. So he thought 13 was too many, it's too confusing. And I thought, well, it's better than 500. Now, what else might you have? So you're going to have your Roth IRA. So I had people ask, well, do I do a Roth or do I do a mutual fund? The answer to that is yes, do that. You can do your Roth in a mutual fund. You can do your Roth in your 401k plan now. Many of them, I don't know if Allison, you have a Roth IRA, 401k, that might be a really good option to do. Well, mutual funds can be indexed or active. ETFs can be indexed or active. When ETF stocks started, they were almost all index funds. They're almost all matching the market. But now today, there's a lot of active ETFs.
What's the Roth IRA?
Well, the traditional, you get a tax deduction today, but you have to pay tax when you take it out. Roth, you get no tax deduction today, but it's tax-free forever, maybe. Because is there anything that prevents Congress from taxing Roth IRAs in the future? They can change the law. Does a country with 30 trillion in debt maybe need to change their tax law? So who knows if the Roth IRA will be tax-free? Because Roth is really popular. So there's a lot of money stuck in Roth, which means there's going to be a lot of non-tax money in the future that Congress is going to say, oh, look at all these rich people. This, you have a $200,000 Roth, that may not be all that rich, but when you got a $30 trillion deficit, you got to pay it, our debt. So we'll see. I'm not so convinced Roths will always be tax-free, but that's the main difference. And the 401k is the same, they can do it both ways. If you do your Roth 401k, it just means you're putting money in, but you're paying tax on it. So it's not tax-free. Whereas the traditional 401k, you're putting money in pre-tax. So you're getting more money in, but then you're going to have to pay tax on 100% of it, not just on the gains. You have to pay a tax on 100% when it comes out on the other side. So most people think Roth is the better deal, but that's assuming tax laws don't change, which is, pretty broad assumption. So yeah, you can do your Roth in a lot of different places. It doesn't have to be. So Roth is a tax structure that a lot of these structure. You can do your Roth in a broker. I have my Roth is in my brokerage account at Schwab, so it doesn't have to be in a particular mutual fund.
So whenever you said the life cycle, the life cycle plans, are those based on the efficient frontier?
A lot of them are. Most of them are doing exactly what we talked about was Horizon. So for what I don't like is for people your age, they're using 90% stocks, 10% bonds, which we talk about in risk makes no sense. You should be 100% stocks while you mess with the 10. And then the stock allocation declines as you age. Now, when we started ours, not in the 401k, but when we did the 401k and then we did it in the mutual fund side, I'm pretty conservative. So I was really conservative with ours, and we started ours in 2008. And so we were like really high ranked because we were very conservative when the market crashed. And then I retired, and I don't know what they did afterwards, but you talk to people that, wow, you're a genius. No, I was just really lucky to be conservative at the right time. And so there are some differences, and Vanguard has them, and they're very cheap because Vanguard just sticks them into their index funds, so they're very, very inexpensive. funds, but yeah, I mean, there's a lot of choices you have to make here. Taxes are important. I'm not a big fan of financial planners because I think they overcharge. I do think one area they add a lot of value is on tax planning. So tax is a big deal. Most people put stocks in the Roth because stocks have the biggest gains. So you want to shield the biggest gains from taxes in the future. I like Roths for option trading because options are the worst tax instrument there is. The IRS is so penalizing to options. So if you can stick those into a tax-free account and trade them without having to worry about tax, that's a really wonderful thing. So I like to stick in fact, sometimes I'll use my Roth to hedge my entire portfolio. So I have all the options there. So if it works out, I got this huge gain offsetting losses and it's tax-free and I can actually harvest the losses. So it can actually be a pretty cool thing to do. But you have to think about that. If you're not sure, most people load up the 401k first because of the matching. And then if you have any left, and you probably won't have any room left, if you have any room left, put it in the Roth. And then after that, you're just going to go taxable as much as you can. These are important decisions. You have to pay, you have your employee orientation. They'll probably spend an hour or two on 401k plans, should ask a lot of questions. And some of these plans, USA started allowing employees to borrow against their plan, which is shocking to me that I think over half the employees borrowed from their plan. We were shocked. I remember in a committee meeting, they were like, what? How many are, yeah, a bunch of them are borrowing. So we got some distressed employees. It was pretty sad. And some of them, and even understand it, because when you borrow from your 401k, you got to pay interest, but the interest goes back into your account. And so our employees are thinking, well, that's interest free. I'm paying myself the interest. So it's like a free loan. Well, if you take 50,000 out of your 401k plan and the stock market goes up 10% and you pay that 50,000 back with interest, what was your interest cost? You lost 10% on the market when you take the money out. So that's the true cost of taking the money out, is you miss the opportunity to be in the stock market. So if the stock market crashes, you're kind of glad you borrowed money from your plan, because then, you did what you did with money and paid it back. But yeah, a lot of employees, I could tell, just did not understand these plans very well at all. In fact, one guy emailed me, he was really irate. He said, I put my money in a stock fund because y'all say stocks are more risky, so they have higher returns. And yet I lost money this last quarter. That doesn't make sense to me. How do I lose money? I was like, that's the more risk side of the, he was like, higher risk, higher return. I should always have a higher return. I was like, no, you have to have negative return. And it was kind of awkward explaining that to him because it seemed kind of obvious to me, but I had to be real nice. It's like, no, you're going to lose money. All right, major indices here. The S&P 500 is probably the most quoted. It's the first one when you go into Yahoo Finance. It's a market cap weighted. So what does market cap do for you? So biggest stocks get the biggest weight because it's based on Apple is going to be the biggest stock in your portfolio. So it gives you an advantage, gives you a disadvantage. The advantage is it's a momentum strategy. You're allocated to the most expensive stocks, and momentum works really, really well until it doesn't. So stocks that are up tend to keep going up. So that's the momentum strategy. The negative side of this is reversion to the mean. You have most of your money in the most expensive stocks, they may be the most likely ones to crash. So you kind of balance those two positions. But yeah, market cap weighted. Dow Jones, I can't even explain Dow Jones. It's price weighted, which just doesn't make sense to me. A $50 stock and $100 stock. So you put twice as much on the $100 stock than the $50 stock. But then the $100 stock does a 2-for-1 stock split, so it's now $50. So the Dow actually adjusts for that. So it doesn't cut that in half. It has to keep track of all the stock splits over time. To me, it's just a bizarre animal. You should look at the history of the Dow Jones. I think there was only one stock that made it a long time. It might have been Exxon, and they fell out. So it's pretty interesting looking at the Dow's history because most of them have just stopped existing.
Wasn't it like Western Union?
I don't think they've been in the Dow for a while. They may have been one of the original ones, but I don't know. I'd have to go back and look at the history. I thought it was one of the big energy companies. Like Bethlehem Steel, obviously there's some industries here that really gone out of. How many do you know? American Can, I did a case study on American Can. GE could have been it. They toppled pretty fast there. It's possible. GM want to going out. Radio Corporation, Sears, Roebuck and Company. Wow. Have any of y'all never been in a Sears in your life? Anybody here? Never walked in a Sears before? Standard Oil, obviously they still exist, but I mean that is Exxon and Chevron, and that's all of them. Free. Wow, there's two companies called Texas. US Steel still around. Westinghouse kind of still around. Woolworths, I don't know if they're still around. So yeah, maybe it was GE was the one that made it the longest, the last. Now the Dow and the S&P have been really radically different the last few weeks. There's been some bizarre days where the S&P was up a bunch and the Dow was actually slightly down, and it's because the Dow is only 30 stocks, so one company can really drive the Dow much different than the S&P with 500. So I would not recommend the Dow. It's just a bizarre allocation. Small cap, for some reason, Russell gained the market there. So the Russell 2000 has just traditionally been the small cap index. S&P has the S&P 600, which is their small cap. It's just not as widely followed as the Russell 2000. Mid cap is kind of a new asset class of the S&P 400. So S&P has the S&P 500, S&P 600, and S&P 400. And so then you can buy the S&P 1500, which is all of those together. Russell has a Russell 1000 and Russell 2000, combined Russell 3000. They just have large cap and small cap. They don't really have a mid cap in there. And both of these break theirs between growth and value. And it's pretty simple. What Russell does on growth versus value, they just take every stock and rank them by price to book. And the highest ones are their growth, the lowest ones are their values. Real simple. I don't know what they're doing today with all these companies with no book values. So they don't have a price to book. I don't know, maybe they're just kicking them all into value stocks. Developed market is usually MSCI EFA, and I can't remember the EFA. The FE is Far East. Europe, maybe it's Europe, Australia, someone should look it up. I can't remember, but yeah, but there's no Canada in there. Remember we talked about that earlier. So Canada is not in the EFA. That's the one developed market that's really not represented because the Canada is in North America. Emerging markets, again, MSCI, Morgan Stanley, capital indices. They're famous for non-US stocks, but they have their US market indices as well. MSCI large cap, US large cap. They have those as well. They're just not as well known. Bonds. So it used to be Lehman and Merrill Lynch. And those two firms died in 2008. I think Merrill Lynch is still around, but Lehman is not there. Barclays bought Lehman or still. They actually got sued because they bought Lehman so cheaply. They had to move fast. So if you think about it, Lehman was the bond king of the world. They had the best employees and their company's bankrupt. You got to move fast to capture those employees. And that's what Barclays did. They bought it cheap and got all those employees, and they became overnight the bond king. So now it's the Barclays Ag, but those are the US bonds. So you got to be real careful with bond indices. They can be 40% US treasuries, 30% mortgage backs. You can be really heavily allocated towards treasuries and mortgage backs. Do you want 30% in mortgage backs? Pretty risky asset class. So a lot of people use the Barclays Ag, but then they're 80-90% corporate bonds. So, it's a strange indice. But do be careful on and Barclays and Merrill, they have their corporate indices as well, and their treasuries indices, their TIPS indices. There's all these other indices, but bonds tend to be all against the aggregate. The original indices, they wanted to make them equal weight. So this is a big debate. you're going to create an index for people to go against. And when you take the if you take the CFA exam, there's a whole list of what makes a good index. I don't even know if I can Google that or not. Characteristics. Characteristics a good stock index. You'll read entire papers on this. 6 traits. Let's see if they're the same 6 I was taught. Yeah, they don't have it listed the way I'd like to have it listed, but one is it's got to be investable. You can't have an index you can't actually invest. It's got to be invested. It's got to be known in advance. You can say, hey, here's your index. Let's see how you do. And after we grade you, we'll tell you what's in the index. It's got to be known in advance, so transparent. I forget the other ones. It's been a while since I've taken diversification. I don't remember that one. Transparency, we talked about that. So they have 6. I think I had 3 or 4 in our list, but I can't remember what it is. But there are rules you want with an index. I think investability to me is the most important one. If you can't actually buy the index, then it doesn't make a good index. Today it's so easy to buy the index because we have ETFs that are the index. You can just buy the ETF. Why does it need to be investable? Because what you're trying to say is your customer could have done the index or could have done the benchmark. Instead, they invested with me. If they can't actually buy the index, you can't tell them, hey, you had a choice between the index or me. So you need to be investable, but that's pretty simple, pretty easy to do today. There are places you can actually put your money that will follow these indexes pretty closely, very, very closely. But the original index, they thought the best way to do this is just make them all equal weight. So if you have 500 stocks, you just put 1/500th in each stock. And there are studies, you can find them, that says that's actually a very good strategy. Now, why would that be a very good strategy? Well, if you think about it, it's a value strategy. Because you put equal weight in every stock, you're going to over allocate to the cheap stocks and you're under allocate. 1/500, you're going to be really under allocated to Apple. So it ends up being a value strategy, and value strategies have done really well over the long term. So that's probably why equal weight has done well, because it's a value strategy. Why did they move to equal weight? Well, why did they move to market weight? Because equal weight is very, very expensive to maintain. If you buy 500 stocks, each with 1/500th, as soon as market prices change, you're no longer balanced. You're all over the place. So then you have to decide when to rebalance. So you got to trade all the time. If you do the S&P 500, where you own 500 stocks at their market cap, you never have to trade unless the stock goes in or out, because it's always at its market value. So if Apple is 6% of the market, you buy at 6% of Apple, 6% of your portfolio is in Apple. If Apple falls to 4%, the index falls to 4%, you fall to 4%, you're balanced. And so remember, turnover with a market weighted index, turnover is very, 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 very low, like 4% or something, just very, very, very low. So equal weight is probably the better strategy. And the nice thing about a small investor is equal weight's really easy for you. You just rebalance maybe every quarter. In the investment society, our portfolio was equal weight. And we just had rules for when we rebalanced. But something got this much out of sync, we would rebalance. You don't want to rebalance too often because you do want to allow momentum to run. And if a stock is getting above it, you want to let it run for a while, but you do want to rebalance every once in a while. And most studies I've said rebalance quarterly. I don't know why, I can't remember their math. A new one that's come up is called fundamental weighting. And if you can type Robert Arnott. In fact, you can do Robert Arnott versus Cliff Estes, and those two are constantly at each other's throats over this. I'm going to show you all that early. There's some really good. Really good stuff. There's probably some YouTubes with the two of them debating. And that's one of the things they're debating is this new approach. You may have heard it as some people call it smart beta. Have y'all heard that term before? You could probably Google smart beta. So they're saying it's It's still beta. It's not an active strategy. It's still beta. You're still getting the markets, but it's just how we weight it a little different. We're doing it in a really smart way. Cliff Asness says, no, you're not. Cliff Asness says, essentially what you're doing is you're a value investor. So instead of putting 6% in Apple because it's 6% of the market, you put 4% in Apple because their revenues are 4%. You're using revenues instead of market price. That's going to be a value strategy. It's just an obvious value strategy. So you can see the Cliff Asness blasts Robert Arnott. Now, do you think Cliff Asness likes Robert Arnott? Absolutely. They highly respect each other. They blast each other in the press, but they highly respect each other. And the two of them are geniuses. So the two of them together, there's Cliff Asness right there. The two of them are geniuses, very powerful. Robert Arnott's probably one of the best conference speakers I've ever heard. Just such an influential speaker. Just his mind's always working, and he agrees with Cliff Asness on the complaints, but he still thinks it's a better way to go. So there's a lot of study you could do there because this is pretty debated. Is there a better way? You know, this is kind of the better mousetrap kind of thing. Is there a better way to put these things together such that you don't spend a lot of money, but you end up with a better return at the end? And most of them end up looking good because of the value bent. It's just kind of the nature of how fundamental weighting works. But that's fundamental weighting. So Victory Capital started a smart beta fund. I don't know how it's done. The guy who did it was a UTSA student, so I should invite him to come back. A guy named Lance, another Lance, not this one, but so interesting. I'd be interested to see how he's done. He's learned an awful lot doing it, so he could be really, really insightful in telling us how he did that. I gave you the methodologies on Blackboard for S&P and MSCI. I would recommend reading S&P. I think I showed y'all S&P earlier. It's just a lot shorter. MSCI is like 100 pages, but it's still fairly interesting. This is an entire science and an art of how to construct. This is what you want to do. You want to construct an index people start using because it's like the easiest way to make money. Then if a mutual fund puts your indice on their mutual fund, they got to pay you a royalty fee just for using like S&P 500 fund. You have to pay S&P money just to use their name. It's a really cool way to make money if you can create one people use. So all right, so there's obviously there's a lot of the UK market, Germany. You can break these down country by country. The Nikkei. So let's talk active versus passive. I don't know if this clock is correct or not. 52. Ah, all right, that's right. So active versus passive. Which should you do? Active, you're trying to pick stocks or pick managers. You pick stocks if you do it yourself, or pick managers that are going to beat the market. So that just means going to have a higher return than that benchmark. So if the S&P 500 is up 4.2%, you need to make 4.2% plus your fees. So if your fees are 50 basis points, you got to make 4.7% just the tie. Now you might say, well, what about Vanguard's S&P 500 fund? They have fees too, but yeah, remember they do securities lending. They're going to make all those fees back. You're essentially going to get the S&P 500. So you can get the S&P 500 almost two or three decimal places out. If you graph the S&P 500 and the Vanguard S&P 500 fund, it looks like one line. You can't tell the two apart from each other. It's just right on top of each other. So it's very easy to get the S&P 500. To beat the market, you got to spend some money. You got to hire analysts. You got to do some work. That's going to cost you some money. And so you start off already behind just because of your fees. Your alpha is how much your return is minus the market, and alpha can be negative. I still have a t-shirt. I don't wear it anymore, but it was a hedge fund, I think Westridge or something. And the back of it said, alpha is life. And that was their t-shirt. I love that T-shirt until they went out of business for corruption, and so I don't wear it anymore. But they were a Madoff situation, but without all the press. So kind of interesting. We were talking to them, but we never gave them any money, fortunately. But they said alpha is life. Why? Because they're a hedge. I mean, that's what they're doing. They're trying to beat markets, and that was their particular model. So you're trying to find managers that can consistently outperform. That's where I talk about the batting average. The problem is performance is extremely inconsistent. It's really hard to tell luck from skill. You can use the T statistics kind of things you use in stats, but when you do that, you often find that you need like 40 years of data to have any confidence. And by that time, the guy running the portfolio is probably retiring. And even if they're not retiring, the world may be changing, that what worked really well the last 40 years is not going to work going forward. Now, will AI find a way to beat the market? Or has it already found out how to beat the market? I mean, who's the person we all think of as beating the market? Who's the most famous one? Can y'all think of? James. You know? Y'all see it? Right. But he's also what? An investor? I don't know how to spell Renaissance. There it is. Jim. I don't call him Jim. I call him James. There he is. Y'all recognize him? I don't know if he's still alive. He's got a cigarette, so maybe not. But have y'all heard of James Simons? So Renaissance, massive returns consistently. Not a finance person. He's a mathematician. Essentially AI, but in the human brain. All about the numbers, all about the data. So that's who he is. Is he? I don't see it. They usually put that off on the right, but I don't see it. I can't get rid of that. I don't know how to get rid of that. Go somewhere else. Did I click on that? Into 21 billion. How many math teachers do you know are worth $28 billion? He went to Berkeley. He's got children. So if you're looking for someone to get married to, maybe their kids. So he is, how old is he now? 84. So yeah, 28 billion. I think he probably has something he discovered that does work. It is true. It is there. And he's obviously not going to tell anybody about it. He has no incentive to. And his numbers are just so phenomenal that it's hard to think that he doesn't, but I don't know for sure because I don't know what he's doing. Is it possible it's pure luck? Yeah, I guess it's possible. I remember one meeting, we had an international fund that just did really well the previous year. And I just made an aside comment of, I don't know if it's luck or skill, but they had a really great year. And the president of the investment company goes, "You don't have numbers like that if it's not skill." You go, "Okay, whatever." The next year, that manager had a horrible year. Saying, "What happened? Did your IQ, did you drink some really bad water? What happened? Was it skill or was it luck? Who knows?" But they had a great year, then they had a horrible year. So it's really hard to tell the difference. Passive, you just buy the market. You're buying index mutual funds, commingled accounts, ETFs. You believe probably in the efficient market hypothesis. I was listening to Warren Buffett this morning on when I was on my bike, bad mouthing efficient market hypothesis. Good old Munger, he gave the analysis of this doctor who was doing cataract surgery the old-fashioned way with scalpels and stuff, where there's a much better way. And he said, "Well, why are you still showing that to your students?" It's just a lot more fun thing to teach in the new way. And he said that's what finance professors do. we're teaching stuff we know doesn't work, but it's just so much more fun to teach it because the math all works out and it's all real pretty. So he's pretty negative on, and that was his main thing, the efficient market hypothesis. He thought schools are teaching this thing. So you need to know about the efficient market hypothesis. It's pretty important. I would highly recommend you read Andrew Lowe, Adapted Market Hypothesis. So he has a book out on it where he talks about the efficient market hypothesis, actually even proves that that's not correct. Pretty interesting book. Smart guy, good book. It's interesting. He presented his theory at a conference showing that efficient market hypothesis had some problems with it. And the guy who got up after him said, well, obviously you have some errors in your data. So once you fix that, let us know. And that was the mentality. You can't badmouth efficient market hypothesis. And so that guy went back and reran Lowe's numbers and discovered that he was correct. He had actually proved his point, and so he had to call Dr. Lowe and apologize to him. So our market's really efficient. And there's two ways they can be efficient. They can be informationally efficient or fundamentally efficient. Information efficient means new information comes out and prices react in a nanosecond. I mean, it's like really rapid fire. And I saw that in my career. You know, you're sitting there waiting for a firm to report. As soon as I report, everybody's just flying around or updating their models or making trades. I mean, it's really fast, really fast. Fundamental efficiency is there are no mispriced securities. So there's no errors in one direction. You can have errors, but they should offset each other. Some people think this, some think this. There shouldn't be a bias in one direction on errors. So you shouldn't have any bubbles. Errors should be uncorrelated. So those are the two approaches. And then to test that, we've had 3 tests: weak form test, semi-strong, and strong form. The weak form test just asks, hey, can you use prior prices to predict future prices? That's the chartist technical analysis. Does technical analysis work? So y'all probably heard of Eugene Fama, right? Y'all ever heard Eugene Fama is still around. He's still around. Still a very much efficient market hypothesis person. He's working for some funds that are trying to beat the market. So you might say, some people are criticizing, say, you're an efficient market person and you're working to try to beat the market. He says, no, I'm not. I'm buying certain risk that I believe are getting paid for. You know, he's like, he stays with the efficient. Yeah, I get a higher return, but I'm taking higher risk. You're like, well, where are you taking the higher risk? We haven't figured that out yet. But obviously, these consistent higher returns must be higher risk. So that's kind of like, you know, he's falling back on the efficient. But what he did, one thing he did I thought was pretty impressive is that he created stock charts just randomly. And he went to technical analysts and said, look at these charts. And analysts couldn't tell there's between a randomly created chart and an actual stock chart. To them, they all look legitimate. That, you know, you can create something that's random and it looks like there's something actually going on. Obviously, you're seeing something that's not there. The semi-strong refers to public information, financial statements, management speed. And that's the test of fundamental analysis. Can you take all the information you have on the stock, put it into a model, and come up with something that will consistently beat the market? And obviously, that's going to be kind of tough. But his study showed it doesn't work. Later studies have been a little bit more inconclusive. Markets obviously react to information real quickly. Hedge funds have discovered the earnings drift, which what happens is a firm produces really good results and the stock price doesn't rise enough. It kind of trends up over time. A firm produces bad information, the stock doesn't fall enough, it kind of falls and then it falls slowly. And so hedge funds have taken advantage of that, but that's somewhat disappeared. So, you know, there are a few anomalies that people have found with public information. So those fundamental analysis beat the market. You know, it's hard to prove that because you don't know what everybody's doing. But, you know, it's tough. It is very tough. Today, especially because we have so much information, you can bring millions of pieces of data into an Excel spreadsheet and do all kinds of analysis, will you come up with something that will predictably make you beat the market? And that's kind of questionable. The last one's a strong form. Is that all information, public and non-public? And if you had non-public information, can you beat the market? Well, that's really hard to test because there aren't many people out there saying, hey, I'm breaking the law using non-public information. So it's going to be hard to tell. One of the tests that he did was he watched CFOs of major corporations and watched how they traded their company on stock. So if the CFO every year sold 50,000 shares, and in 1 year they traded 200,000, you go, okay, they just sold 200. They usually sold 50. They must have inside information. They're obviously selling, and trying to test that to see what's going on. The biggest test we've seen is Congress. Congress is allowed to trade on inside information. Does that give them an advantage? The one study I saw showed that they still underperform the market, even with that inside information. So maybe they're not all that bright, but they can. And there's been laws throughout the past that, hey, if you got some inside information from the Fed's going to do something that's not been reported, you should be able to trade on that. Wouldn't you agree that should be illegal? So I think all members of Congress should probably have their assets in a trust without, blind trust that they can't actually see what's going on. Now, what about Andrea Mitchell? What do you think? Y'all know her? Have y'all heard of Andrea Mitchell? What's famous about Andrea Mitchell? No one knows who her husband was or is. All right, so she's married to a former Fed chairman. Should she be allowed to trade stocks? Who's her husband? Anybody recognize this person? Wow, I guess it has been a few years. Who is that? Alan Greenspan, right. Yeah, she's married to Alan Greenspan. Yeah, she was a journalist for some time. I don't know if Greenspan's talks in his sleep, but she had access to inside information. Should she be allowed to trade? Says, yeah, I don't think we're going to cut rates tomorrow. We told people we were, but we're not thinking about it. Well, can you announce that like at 9:15? I might make a few trades in the morning. So inside information, yeah, it's out there. It is illegal unless you're a politician. What happens if you trade on it? You go to jail. It has to be, the rules has to be material non-public information. You can trade on immaterial non-public information. That is legal. But who decides if it's material, immaterial? Do you decide that? The jury's going to decide that. So that's not yours to decide. What if you found 1 million pieces of immaterial non-public information? Could you trade on that on a particular company? The answer is yes, that's legal. If the combined non-public information is material, even though each piece is immaterial, that's legal. I don't know if that's ever gone to court ever. That seems like a really bizarre thing. So you can trade on non-public information, but it better be immaterial. So what do you actually do? So you're on the plane next to the CEO of Valero, talking to the CFO, and you hear them say, wow, when this hits the press, this is going to be big. Can you run home and trade Valero stock? What would you actually do? As soon as the plane lands, you're going to call whom? Not your broker. No. No. You're going to call your lawyer and say, I just heard non-public information. Your lawyer is going to call Valero and said, you had non-public information. They hit. You need to announce that immediately to the press. That's the way it's going to work. Don't trade on it. You might say, well, they'll never figure that out. Say, oh, wow, Waylon, you're on a plane. Let's see. Wow, Valero stock just fell 20%. Wow, Waylon just did 1,000 put options on them. Oh, look, he's sitting next to the CFO of Valero on a plane. Wow, that's interesting. Oh, not only that, but his cousin did 1,000 shares as well. Yeah, you're gonna go to jail. You're not gonna get out of that. They'll find that out. And I'm sure the SEC, when a stock moves a lot, they probably go look for unusual trades that happen right before that. So it's not that difficult for them to figure that out. Now, Martha Stewart, I don't think she actually went to jail for non-public information. Y'all don't even know who Martha Stewart is. She did what?
She's trying to sit down.
Oh, I don't know anything about that, but. So I think she went to jail for perjury. I don't think she went to jail for inside information, but she was accused of that. So that's part of it. Is what's amazing is how wealthy she is and how little the money involved was that put her in jail. So I tell you what, if you're worth millions of dollars, I wouldn't risk going to jail for a few thousand. I just don't think it's worth it. It's kind of my P&C class. Anybody hear my P&C class? I think you're right. Yeah, this guy who made hundreds of millions of dollars and he goes to jail to try to make a few extra million. It's like, once you get to like 500 million, maybe you should just be happy, not risk jail term. So if you take the CFA exam, there's a big part of the CFA exam on non-public information, what is, what isn't, what you can do. But the answer is always call your lawyer. If you're not sure, put it on your lawyer. Now they haven't, well, you haven't told them the inside information. But they'll tell the firm, release it immediately. That's what you need to do. If a firm accidentally lets information like that out, they need to just go to the press and release it to everyone. Even if they don't want to, they need, if 3 people know, they need to go tell the entire world. I don't know what their ramifications are, but they could be sued, obviously, if a bunch of people do trades and take advantage of it, and management should have. So you have the typical stockholders can sue management for not doing the right thing. The social purpose of investing, active investing, some people are worried that indexing is going to take over, and then who's going to decide who the good companies are and the bad companies are. I don't think that's an issue. I think indexing is like 30% of the trades. So there's still 70% going on. So there's something called allocative efficiency where you want a bunch of people out there actively trading so that bad companies like Sears go out of business, Toys R Us goes out of business, Bed Bath & Beyond go out of business, and good companies stay in business. But that's still the case. That hasn't changed. So I don't think it's that big of a deal. And I'll finish up with this. Warren Buffett, he said investing is like batting, but where they don't call strikes. So he said you can beat the market if you're patient. That'd be great, except for where I worked. They don't pay you for hits. They pay you for swinging. If you're paid to swing, you're going to start swinging all the time. Why are we compensated like that? Because we got to feel like we're doing something. So, that's just the nature of it. All right. We're going to probably talk expenses. We're going to skip through these other 2 pretty quickly, but we'll get into some interesting topics here, and then we'll get into the valuation side.